The ATM said insufficient funds, but Sarah had checked her balance that morning, $12,000. Now it showed zero available for withdrawal. Her bank account wasn't empty, the money was there, but she couldn't touch it. This happened to thousands of people in Cyprus in 2013. One day normal, the next day locked out. But here's what nobody talks about. The markets were still open, stocks were still trading, the crisis wasn't in the financial news yet. It started with something much more basic, something that happens before anyone realizes there's a problem. What breaks first when the system gets stressed? And how do you know it's happening to you? Look, I know that sounds scary. And maybe you clicked on this because you're worried about your own access to money. That's normal. But here's what I want you to understand. These lockdowns don't happen randomly. They follow a pattern. And once you see the pattern, you can recognize the early signs. By the end of this video, you'll understand what fails first, why it spreads, and what usually breaks next. More importantly, you'll understand why it's never the thing people are watching that breaks first. You'll see how the system actually works when it's under pressure, not the theory, the reality. And you'll understand why normal people get locked out before the big players do. We're going to walk through this step by step, because the order matters. And most people get the order completely wrong. Most people think financial stress starts with big dramatic events. Stock market crashes, bank failures, government announcements. That makes sense, right? You see the headlines. Markets down 30%. Major bank closes. Emergency meetings. So you think that's where it starts, with the big visible stuff. And this feels reasonable because that's what gets reported. When Lehman Brothers collapsed in 2008, that was the story. When Silicon Valley Bank failed in 2023, that made headlines. But think about Sarah in Cyprus. Her problem wasn't that her bank failed. Her bank was still open, still operating, still taking deposits from new customers. Her problem was access. The bank had her money, but she couldn't get to it. Now, you might think this was just a government decision. Politicians decided to freeze accounts. But that's not how it actually works. Governments don't just wake up and decide to lock people out of their money. They respond to pressure. Pressure that's already building in the system. So what creates that pressure? What makes a government feel like they have to stop people from accessing their own money? Here's where it gets interesting. The pressure doesn't come from the accounts themselves, it comes from somewhere else entirely. But this still doesn't explain where the real damage begins. To understand what breaks first, you need to understand how money actually moves through the system. Not the simple version, the real version. Think of the financial system like the plumbing in a large building. You turn on your faucet, water comes out. Simple, right? But behind that simple action, there's a complex system of pipes, pressure, and flow. Your bank account is like your faucet. When you want money, you expect it to be there. But your money isn't sitting in a vault with your name on it. It's part of a flow system. This part sounds small, but it isn't. When you deposit money, your bank doesn't just hold it. They lend most of it out. That's how banks make money. They pay you maybe 1% interest on your deposit, then lend it out at 5%. But here's the key part. They don't lend it to people who walk into the branch. Most of it gets lent to other banks, every single day. This is called the interbank lending market. Banks lend money to each other overnight. Every night. Billions of dollars. Why? Because banks need to balance their books every day. If Bank A has too much cash and Bank B needs cash, they make a deal. Bank A lends to Bank B overnight. Most people never see this step. This happens automatically. Like breathing. The system depends on it. Now imagine you're Bank B. You need to borrow $10 million tonight to balance your books. You've done this every night for years, no problem. But tonight, Bank A says no. Not because you're a bad risk, not because you can't pay it back tomorrow, but because Bank A is worried about their own situation. Hold on to this, it matters later. When Bank A says no, Bank B has to find the money somewhere else. Maybe Bank C will lend it, but Bank C is also getting nervous. So they say yes, but they want higher interest. Yesterday, overnight money cost 0.1%. Today it costs 0.5%. Still cheap, but 5 times more expensive. This is like blood pressure in the financial system. When banks start charging each other more for overnight money, pressure is building, but you don't see this. Your bank account still shows the same balance. Your debit card still works. Everything looks normal. The pressure is building in the pipes, but the water is still flowing to your faucet. Now here's where it gets critical. Banks don't just lend to each other overnight. They lend for longer periods too. 1 week, 1 month, 3 months. When the overnight market gets expensive, banks start worrying about longer-term lending. If overnight money is getting more expensive, what about next week? Next month? So they start saying no to longer-term loans, or they start charging much higher rates. This is where the pressure really builds, because banks need that longer-term funding to operate normally. Think of it like this. You can hold your breath for 30 seconds. That's like overnight funding. But you can't hold your breath for 10 minutes. Banks can't operate on just overnight funding. When longer-term funding gets expensive or disappears, banks have to make choices. hard choices. Now, here's where this gets uncomfortable, because those hard choices don't affect everyone equally. Banks start by protecting their biggest, most important customers, the ones who bring in the most profit, the ones who would cause the most damage if they left. Stay with me. This connects in a way most people never see. Let me give you a real example. In 2008, there was a company called Reserve Primary Fund. They managed money for regular investors, people's retirement accounts, college savings. When Lehman Brothers collapsed, Reserve Primary Fund had lent money to Lehman. Not a lot, just enough to cause a problem. Suddenly, everyone wanted their money back from Reserve Primary Fund, all at once. But Reserve Primary Fund couldn't get their money back from Lehman, because Lehman was gone. So Reserve Primary Fund had to tell their investors, your dollar is now worth 97 cents. We can't give you the full amount. 3 cents doesn't sound like much, but think about what that means. You put $100,000 in what you thought was a safe account. Now it's worth $97,000. But here's the really uncomfortable part. The big institutional investors got out first. They had direct phone lines to the fund managers. They could move millions with a phone call. The regular investors, they had to go through the normal process, fill out forms, wait for processing. By the time their request went through, the money was gone. Let me give you another example. This one hits closer to home. Small businesses usually have what's called a line of credit with their bank. It's like a credit card for businesses. They can borrow up to a certain amount to cover payroll, buy inventory, handle cash flow. These businesses depend on this credit, not because they're failing, but because cash flow is lumpy. You might get paid by customers in 30 days, but you need to pay employees every 2 weeks. When banks get nervous about lending to each other, they also get nervous about these credit lines, not because the businesses are riskier, but because the bank needs to keep more cash on hand, so they start reducing credit lines, or calling them in entirely. Imagine you're a small business owner. You've had the same credit line for 5 years, never missed a payment, good relationship with the bank. Then one day you get a letter. We're reducing your credit line from $50,000 to $20,000, effective immediately. You're not a bad customer. The bank isn't failing, but the pressure in the system is forcing them to make choices, and you're not their biggest customer. So now you can see the sequence. It doesn't start with your bank account. It starts with banks lending to each other. First, overnight lending gets more expensive. Banks start charging each other higher rates for short-term money. Then, longer-term lending starts to dry up. Banks stop lending to each other for weeks or months at a time. Only after that do banks start making changes that regular people can see. Credit lines get reduced. Loan applications get rejected. Interest rates go up. Here's the cliffhanger. Even at this stage, your bank account still works normally. You can still withdraw money. Your debit card still works. Your direct deposit still goes through. The system is under stress, but it's still functioning for basic operations. But this still isn't the final break. The next stage is when banks start competing for deposits, when they start offering higher interest rates to attract money from other banks. This sounds good, right? Higher interest on your savings account. But it's actually a warning sign. Banks are paying more for deposits because they can't get money from other banks anymore. It's like a store having a big sale. Looks good from the outside, but usually means they're desperate for cash. When banks start competing aggressively for deposits, they're trying to replace the funding they used to get from other banks. And here's what most people don't realize. This competition creates winners and losers. The big banks, the ones that are seen as safest, start attracting deposits from smaller banks. Money flows uphill towards safety. The smaller banks, the regional ones, the community banks, start losing deposits. Not because they're bad banks, but because people get nervous and move money to banks they think are safer. This creates a feedback loop. As smaller banks lose deposits, they become actually riskier, which makes more people move their money, which makes them even riskier. The last stage is the one people don't prepare for. It's when the government steps in. Not to fix the problem, but to control it. This is when you get account freezes, withdrawal limits, capital controls. The government doesn't do this to hurt people. They do it to prevent a complete collapse of the banking system. But the effect is the same. Your money is there, but you can't access it. Now, here's what makes this whole process so dangerous. It's not really about money. It's about confidence. Think about your own behavior. When do you start to worry about your bank account? Most people don't check their account balance every day. They assume it's fine. They trust that the system works. But when you start hearing stories about other people having problems, you start to pay attention. Maybe a friend mentions that their business credit line got cut. Maybe you read about a bank in another state having problems. Maybe you notice that your bank is advertising higher interest rates. None of these things directly affect you, but they change how you think about risk. And here's the key insight. You don't have to panic to cause problems. You just have to be a little more careful. Instead of keeping your usual balance, maybe you withdraw a little extra cash, just in case. Instead of using your debit card, maybe you use cash more often, just to be safe. Instead of keeping all your money in one bank, maybe you open an account somewhere else, just for diversification. Each of these decisions is completely rational. You're not panicking. You're just being prudent. But when thousands of people make the same rational decision at the same time, it creates pressure on the system. Banks notice when people start withdrawing more cash. They notice when deposit growth slows down. They notice when people start moving money around, and that makes them more nervous, which makes them more conservative with their lending, which creates more pressure in the interbank market. It's a feedback loop. Rational individual decisions create system-wide stress. This is why confidence is so important. The system works when people trust it, when they don't think about it. But once people start thinking about it, start questioning it, start being more careful, the dynamics change. You can see this in your workplace too. When rumors start about layoffs, people start behaving differently. They're more careful about expenses. They update their resumes. They network more. Each person is just being prudent. But collectively, it changes the atmosphere. It makes the rumors more likely to come true. The same thing happens with banks. When people start being more careful with their money, it makes the banking system more fragile. Not because people are doing anything wrong, but because the system depends on people not thinking about it too much. So now you understand the sequence. It starts with banks lending to each other, it moves to business credit, then to competition for deposits, finally to government controls, and you understand why normal people get affected before they realize there's a problem, because the early stages happen in parts of the system they can't see. By the time you notice something's wrong, the pressure has been building for weeks or months. But here's what I want you to take away from this. Understanding this pattern doesn't mean you should panic. It means you should pay attention to different signals. Instead of watching stock market headlines, pay attention to what banks are doing. Are they competing more aggressively for deposits? Are they tightening credit standards? Are they advertising higher interest rates? Instead of worrying about dramatic events, notice the small changes, the gradual shifts in how the system behaves. Most importantly, understand that this isn't about good banks and bad banks. It's about how the system responds to stress. Even good banks, well-managed banks, have to make hard choices when the system is under pressure. The goal isn't to predict when this will happen. The goal is to recognize when it's already happening. Because by the time it's obvious to everyone, the early stages are already over. What signals do you think most people miss when the system starts getting stressed?